We're discussing what Budget 2017 means for your taxes and your finances. And housing is under our radar at the moment because there are some very important changes that have happened. For immovable property, the definition of long-term has been tweaked from 3 years to 2 years. So you start getting the benefits of the long-term capital gains tax exemptions or the prevailing regime by holding immovable property now just for 2 years as opposed to 3 years earlier. Sanjay, is that good news or not?
It is very good news because you have this situation in Mumbai or many other metro cities that people typically change houses for many reasons. So I think it's good in one way, but effectively there are three major changes on this part. One is what you just said, 36 months to 24 months. The second very interesting thing which has happened is indexation. So when you compute long-term capital gains, you are allowed to index the cost. And the way it worked was that you could take a value as of 1481, and the 1481 was a base 100, and you had the index available every year, which you could multiply to your cost. This has moved to 142001. So what it means is that you can take a fair value of your property on 1st April 2001, and the base 100 moves to 1st April 2001. I think it's a great thing because indexation did not move in line with the fair value, so you are able to replace fair value for indexation for 1/4/2001. The third interesting thing is that
generally, just to come in on that, generally should we assume that the tax liability will go down with this new method of calculating indexation?
Tax liability should go down with this because your fair value will go up. That's something which is a benefit. And the third one was that when you had capital gains, you had the opportunity to invest in securities and not pay tax if you invest in those securities and keep the holding for 3 years or so. There was very limited opportunities to invest, and the government is planning to expand the securities so that you can invest in many such securities and avail of tax exemption. So I think put together, one would pay less tax on capital gains on house property.
Okay. Samir, from a taxation standpoint, whether it's housing, whether it's securities, listed or unlisted, anything that really stood out for you, any of the fine print points that we should keep in mind?
Yeah, I mean, first of all, I think this is clearly a budget to boost, or rather primarily one of the objective being achieved is real estate, and to that extent affordable housing. And there are a series of amendments which have come. Of course, we'll stick to individual because there are a lot of amendments come for developers.
For the sector, for the developers.
As well. Yeah. And as Sanjay rightly said that yes, encouraging. So of course, 3 to 2 years again was consequential because if you held shares of an unlisted company, again the long term was 2 years period. Which was of course extended from 1 to 2 years. So they have brought immovable property in line with in terms of securities. So that's kind of gelling with it. Second aspect, of course, indexation is a major booster, but also small benefit given.
I know it's really early days, but if you were to hazard a guess, by how much does the tax liability go down as a rough percentage because of this new method of calculating indexation? Any sense or any guesstimates on that right now?
So, in my opinion, Surabhi, what's happened is, from 2001, the movement in the real estate market, if you look at the metros especially, has been significantly lower relative to the couple of decades before that, because the base was too small in 1981. So coming back to what kind of capital gain tax, if you relatively calculate it from 1981 or 2001 as the base, I think there could be as much as a 30-40% reduction in the capital gain implication. That's the kind of quantums, because I was computing it for a couple of properties to see the relative difference, and that's what it gets to. But of course, there's some more fine print to come.
Sure, absolutely. So now let's steer the conversation towards overall wealth management, and what does Budget 2017 mean for my money and my portfolio? Nitin, your thoughts? I mean, as we said, there's a lot that's not really happened. Materially, no big changes, whether you're investing more in equity or in debt. No further, great tinkering on the NPS side. From the wealth management standpoint, what changes, if anything?
No, I think, as you rightly said, what has not happened is actually more important than some of the things that have happened. There was this hangover about a probability of some kind of a long-term capital gains being introduced, which I thought was slightly unfair, because if you think at a fundamental level, equity owners are shareholders in the company, They are the owners of the company, which is actually paying 30-35% tax any which way. So all the growth that comes in equity is actually post-tax, which this doesn't exist in most economies in the world, and I don't think it should exist in India. So that was one hangover, and the great news is that it stayed that way, so which is very positive for the market, and that's why probably also saw equity markets reacting positively.
Yeah, so no bad news is good news. That's been the one standard line we've been hearing throughout the course of the day.
It has been, but there's one very good news, and that I'm not sure whether that's got highlighted enough for the day. The net borrowings for this government this year are around 3,25,000 crores. So around 75,000 crores less than last year. Talks about the buoyancy in collections, growth in revenue. This decrease in borrowings is actually a phenomenal thing from a bond market's point of view. Because the less the government borrows, there's more available for the other participants to borrow. So that's a crowding out effect, right? Yeah. And if that comes down, I expect generally the interest rates, if this stays for another year or two, generally the interest rates would be on the downward slope.
Okay.
If that happens,
good for debt funds?
So I'm just coming to that. Okay. If that happens, then any debt fund which has duration in it will tend to do well.
Okay.
Yeah. So that is good news from a debt market's point of view. But this reduction in interest rates will also pass through the balance sheets and P&L of companies eventually, which should mean
higher corporate earnings.
Higher corporate earnings.
Better EPS, hopefully.
Hopefully EPS, and hence growth. And market is also not positioned for it. And that's why I think it's a net positive for debt as well as for equity.
So there's more to the rally than the 400 points that we've seen already.
I suspect that.
Okay. Feroz, your broad thoughts on overall sort of asset class changes. Is there anything that you would recommend to the people that you advise right now, having heard everything with the big event out of the way?
Correct. I think there are two parts. One is the taxation bit. I think tax can do little for you. But yeah, in that I would definitely want some attention to the debt side. A debt mutual fund which was moved from 1 year to 3 year, if that was brought back at par with unlisted equity and immovable property, I think it would help. Because holding on for long periods of time in a falling interest rate scenario could be detrimental to the portfolio. And the investor is actually in a catch-22 situation. He sees falling interest rate scenario, but he still can't exit and book profits from it because he pays 33% tax, and most of the speculative gain on interest rate fall is getting eroded. So that I would have definitely wanted to see that some degree of cushion on the debt side, but that didn't happen. But I think from an equity standpoint, I think there are several benefits from a taxation standpoint which stayed, which I feared could actually be moved. The most popular one was, of course, the long-term capital gain, but the dividend distribution tax on mutual funds, equity mutual funds being at zero, which I was suspecting that could come into somebody's notice, and then you would definitely lose it, because that still remains as is.
So actually, let me bring in the tax experts on this as well. And Sanjay, maybe you coming in, there was a bit of a sort of talk in the market that will there be any kind of a change in the DDT structure? So that's not happened. So dividends in the hands of the individual recipient, they remain completely untouched, right?
Correct.
Okay.
So that's on the mutual fund.
Yeah.
But dividend distribution of a stock which you hold in your demat account, there's a limit of 10 lakhs, like the last budget. Above 10 lakhs, then you pay 10%.
You have to pay 10.
And I think that space, whoever it was eligible to, that has been expanded a little in the fine print. I think it's still to be discovered, but that 10 lakh limit was specifically only for individuals, HUFs, and firms. I think now it's getting expanded to companies as well, so that will come in the fine print.
Okay, so we spoke about debt funds briefly. Which are the right kind of debt funds to be in right now? We just heard a view there on duration funds, and Feroz, from your standpoint.
See, I think if you're speaking about liquid monies, which are for shorter periods, then I would definitely not recommend a debt fund in the first place. There's another fund which is called an arbitrage fund, which has a risk-return profile identical or very similar to a liquid fund, but still gets the dividend distribution tax at zero. Unlike a liquid fund or a liquid plus or a short-term fund, where dividend distribution tax is upwards of 30%, here there is an arbitrage fund with a similar risk-return profile giving you a zero dividend distribution tax. That's actually was my fear, that it would get plugged. You would almost make about 5.5–6% post-tax, which is as good as a 9% fixed deposit, which is available to you with a 15-day kind of an investment period, which is what I would recommend.
So quick point once again, going back to LTCG, and there was one of the notes in the annexures which raise the probability or the possibility of people who will not enjoy LTCG benefits. This is people who have not paid STT or securities transaction tax. Is that creating any kind of confusion? If you could throw some light on that, Sameer.
Yeah. So before I come to that, at least on this dividend, obviously I agree with you. There was a lot of expectation that probably DDT may come down, or there will be some more tinkering. That 10% which is being made applicable in the hands of individual who receives more than 10 lakhs. But the amendment which seems to have come, at least the fine print seems to suggest that they have exempted the exempt trust and institutions who used to receive this dividend, and they also ended up paying 10%. So all those exempt charitable trust and other institutions, educational institutions, have been sort of removed, and that's why they have changed that definition. And companies still remain out of the tax, so they are not within the limb of it. But yes, one has to still get into the finer aspect of the fine print, this prima facie. Coming to your point, essentially what happens is that they have said that if there is any security which you have acquired without paying STT, and you are selling that security when it gets listed by paying STT, the question, the earlier that point of time, you used to still get exemption under capital gains tax being long term by paying STT. Now they have said that yes, this is something which you will not get exemption if it is long term, and that gives us rise, especially to ESOPs, that whether ESOPs will now get trapped in this amended, which employees actually got it as part of salary, they paid salary tax, and now when they are liquidating, they are not getting benefit of.
So those are certain very critical questions, and of course we will wait for more clarity to emerge from North Block. But gentlemen, thank you so much for giving us your initial thoughts on what Budget 2017 means for you and me and our personal finances.